Welcome back. This is Accounting 2, and we are in Chapter 13 talking about the journalizing of payroll. Last section, 13.1, we talked about employee payroll, and I concentrated or emphasized the E on the payroll. That is the paid cash for semi-monthly payroll. That is coming up with a transaction to pay your employees. This is the additional taxes that the employer has to come up with because you are more expensive to your employer than just your hourly wage or your salary. The employer has to come up with and pay additional taxes on your behalf. Now, it's a cost to the business. It is not a cost to the employee. In all of these four taxes we're going to talk about here, these are coming out of the employer's profits or a cost of running the business. They are not being taken away from the employees. That's why we emphasize the employer payroll. We have four of them. The employer payroll includes matching dollar for dollar Social Security tax payable, matching dollar for dollar Medicare tax payable. So we take 6.2% out of your paycheck in Social Security tax. The employer has to come up with that exact same dollar amount and hold on to it because you pay for half of Social Security tax. The employer pays for half of Social Security tax. Medicare, same thing. We take money out of your paycheck in Medicare. The employer has to match that dollar for dollar. The employer also has to come up with unemployment taxes on the first $7,000 you earn in a year. Now, the 7,000 number is from the textbook. That's an old number. I'm sure now that number is different, but the idea is the same. So, two unemployment taxes, one going to the federal government, one going to the state that you're living in, matching Social Security and matching Medicare. All four of those taxes together are called payroll tax expense. So when we look at matching Social Security, Medicare, how do we even find these numbers? Two ways. You can either go look at the employee payroll transaction and just pull those numbers, okay? Or you can go look at either your salary expense or your total earnings number and calculate it that way. Your homework assignments will ask you to try each way. So if we look at a payroll register, right, this is the employee payroll, salary expense, net pay, taxes. Why work harder than you have to? Here are your two numbers right here. I had $354.11 that I took from my employees in Social Security tax. I just got to come up with that same number out of my pocket from the employer side. Same thing with Medicare. I took $82.83 from them. I have to match $82.83. Half from the employee, half from the employer, and then we'll eventually send it off to the government. So in matching that Social Security and Medicare, and this goes back to the calculating of Social Security and Medicare, Social Security is matching dollar for dollar up to the first $130,000 or so. Again, the actual tax rate changes year to year. So the textbook said $87,000. I'm saying $130 here because that's the most current 2020 number, roughly. So same thing, just like the employee payroll, we'll take Social Security out of your paycheck until you've done your fair share. Same thing from the employer side. If you've earned enough to not have any taken out of your paycheck in Social Security, then the employer stops having to kick in as well. But again, that's a ginormous number. Most people are not going to earn that much. And in turn, every transaction, whether it be homework or test, you're always going to have to match dollar for Social Security. Medicare, same thing. Okay, Medicare's every dollar one to dollar half a jillion, doesn't matter. You're going to match Medicare. The employer needs to come up with taxes to cover unemployment for their employees. We're in the coronavirus right now, 2020. We have a lot of people who are filing for unemployment. Right? They're going to file with their own state for unemployment first. And if that state's unemployment pool of money, for lack of a better term, runs out, that state would then go to the federal government. So we're going to withhold some from state, and that's why it's the larger number, because you're going to go file unemployment at the state level. The state of, say, Minnesota would then go to the federal government and say, hey, you know, you've been holding on to a small percentage of unemployment. Boy, we're really getting kicked in the teeth right now. We need some of that money to help subsidize our unemployment at the state level. So we're going to calculate this using the employee's earnings record, and the tax base is going to be $7,000, and that's what the textbook's using right now. Right now, 2020, that tax base is larger, but for argument's sake, we're just going to worry about this 7,000 number. So starting January 1, the employer has to come up with a certain percentage of tax in case we let that employee go for unemployment. Every time they get or earn a paycheck, they have to look and say, all right, have we withheld enough unemployment on this employee? Okay, the employer is mandated to do this for the first $7,000 they earn every single year. So January 1, 2020, let's say all of you work for me. Your first paycheck, you all earn $1,000. Right? I got to pay unemployment taxes on all of you employees. Then the next paycheck, the end of January. Well, you've earned another $1,000. Has that, or is that greater than the $7,000 limit? Not yet. So I got to do unemployment on all of you guys at the end of January. And again, we're earning $1,000 each pay period here. Middle of February, well, you guys have earned $3,000, right? The $1,000 I got to come up with to pay you, I got to calculate unemployment on those earnings again. So it's $1,000 on January 15th, $1,000 January 31st, $1,000 February 15th, $1,000 February 28th, $1,000 March 15th, $1,000 March 31st. Now I get to April 15th. That'll be the last time I have to do it because all of you will have earned at least $7,000. So moving on to the April 31st paycheck, all of my employees, again, way overly simple math, every employee was earning $1,000 each pay period, so I would come up with taxes for the first 7 pay periods. Pay period 8 until the end of the year, I don't have to worry about any unemployment tax on you guys. January 1, 2020, I start over. Boom, 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 boom. What if I hire a new employee midway through the year? Okay, well, I got to start unemployment taxes on that new employee until they've earned $7,000. Once they've earned, not got paid, once they've earned $7,000, then I can stop. All right, we'll hit the pause and start looking at some of this math because this is a little bit longer of a unit.